Welcome back to Iron Financial. I am your lead analyst, and my mission today, as it is every single day, is to help you forge a much stronger portfolio and literally cut right through the market weakness. Look, we do not deal in hype on this channel. We deal in structural integrity. We're always looking for companies with a genuinely solid foundation, and we want to expose the cracks in the armor long before they shatter your returns. So today, we are bringing out the heavy machinery for a complete explainer of a stock that is severely, and I mean severely, testing the patience of retail and institutional investors alike. We're talking about the Walt Disney Company, ticker symbol DIS.
Right, and I am the market skeptic. I'm here to ask the hard questions, the ones you're probably screaming at your screen right now. Is the narrative actually holding up, or is this entire structure fundamentally compromised? Because look, when a massive blue-chip behemoth like this starts showing stress fractures, we need to figure out immediately if it's time to reinforce our positions or if we need to evacuate the site entirely.
All right, let's get our hard hats on and dive into this. Let's get right down to the core of the issue here. Disney just dumped its Q2 2026 earnings report on the market, and the street is completely 100% torn. If you're scrolling through the financial news headlines, you're seeing record revenues, you're seeing streaming profitability, you're hearing about massive new cruise ships, but then you actually check the price action, and it is an absolute bloodbath out there. I'm hearing it from retail traders every single day. Are we buying the dip, or are we just catching a falling knife? So I have to ask the multi-billion-dollar question. Is this a rare generational value play? Are we getting in on the ground floor of a newly fortified Disney? Or is this just a massive value trap? A sinking ship disguised as a luxury liner? And that is exactly what we are here to engineer an answer to. You cannot just look at the facade. You really have to inspect the load-bearing walls. And the only way to do that is to bypass the flashy PR spin and look at the raw, unyielding data provided in their latest 8K filing. Now, the vital context here is the leadership at the helm. This is the very first earnings call held under the leadership of Disney's new CEO, Josh D'Amaro, who took over from Bob Iger back in February. D'Amaro is stepping into a massive shadow. He doesn't just need to maintain the house that Iger built, he has to prove to Wall Street that the foundation is actually sound enough for the next decade of growth. And on the surface, D'Amaro delivered an absolute sledgehammer of a quarter. We are talking about a massive revenue beat here. Revenues increased 7% year over year to $25.2 billion. Let that sink in. They handily beat Wall Street's forecast of $25.06 billion. Income before income taxes increased 9% to $3.4 billion. Total segment operating income increased 4% to $4.6 billion. Structurally speaking, the top line is growing, and they are executing on their long-term growth blueprint. Okay, I hear the top line cheers, I really do, but I am looking at these same blueprints and something isn't adding up. If the foundation is so incredibly solid, right, and the revenue is just beating estimates left and right, then why in the world is the stock down 19% from its 52-week high? The stock has been essentially flat over the past week, just kind of consolidating after a brutal, unrelenting slide. The 52-week range is $91 to $125. Let's put that 19% drop into actual perspective. We are talking about tens of billions of dollars in market capitalization completely wiped out. Gone. That is a massive wealth destruction event in a very, very short window. The street is clearly terrified of something lurking down in the basement. You don't just lose a fifth of your value near an earnings beat unless smart institutional money sees massive, unfixable cracks in the armor.
That is a totally fair challenge. The market is aggressively forward-looking right now, and it's highly, highly sensitive to margin pressure and cash burn. So to really understand this sell-off, we have to isolate the different structural segments of the business.
Let's move straight into phase one of the drill down, streaming profits. For years, streaming was the absolute cash incinerator of the media world. It was a money pit. But right now, streaming is doing the heavy lifting for Disney's financials. It is actively offsetting the structural decay we're seeing in legacy linear television. Just look at the sheer torque on these numbers. Entertainment SVOD, that's subscription video on demand, operating income didn't just grow, it absolutely exploded. We are looking at an 88% bump in SVOD operating income, jumping from $310 million in Q2 2025 to $582 million in Q2 2026. This was driven by a 13% increase in SVOD revenue, pushing up to $5.49 billion. They achieved this through strategic price adjustments, some new international wholesale agreements, and incredibly strict cost discipline, which, yes, included cutting about 1,000 tech positions.
Okay, an 88% bump is impressive. I will admit that. Turning a profit in the streaming wars is notoriously difficult. But let's talk about those 1,000 tech jobs they cut. Is that actually a sign of long-term operational efficiency? Or is it just short-term panic to artificially pump up the margins for the new CEO's very first quarter? I mean, is this profit sustainable, or is it just a one-off accounting mirage to keep investors happy?
No, it is structural, and it is sustainable. The SVOD operating margin hit 10.6% this quarter. That is a massive inflection point. When you cross that double-digit margin threshold, you aren't just surviving anymore, you are building a highly profitable, highly scalable direct-to-consumer machine. And Wall Street rewards scalable profit machines, not cash incinerators. Management is so confident in this new baseline that they've explicitly stated they are on track to deliver at least a 10% margin for the full fiscal year. This means the dark days of bleeding billions of dollars on content just to acquire fickle, low-retention subscribers are officially over. The framework is finally bearing weight. Hold on, not so fast. Let's talk about the quality of earnings here, because right here is exactly where I see the rebar starting to rust. You are out here touting the adjusted earnings per share. And for those of you who are maybe newer to the channel, let me give you a really quick breakdown of what that actually means. Adjusted EPS, it's basically like putting a fresh coat of paint over massive water damage right before you try to sell a house. It conveniently strips out all the ugly stuff. We're talking restructuring costs, severance packages, bad investments, just to make the final numbers look pretty for Wall Street. And yeah, sure, that adjusted EPS showed a nice little 8% rise to 157. But you have to look at the GAAP EPS, generally accepted accounting principles. GAAP is the ruthless home inspector who finds the black mold hiding in the basement. It's the raw, completely unvarnished truth. And GAAP diluted EPS, it completely plunged, down 30% from 181 to 127. That is a gaping hole in the profitability armor, folks. When the gap between adjusted and GAAP earnings is that incredibly wide, it usually means there are sizable non-GAAP adjustments masking the true underlying stress on the company's financials. You just can't ignore that. Look, you absolutely cannot ignore restructuring costs and amortization. I'll give you that. But the core operations remain incredibly robust. Let's actually shift gears and look at the physical assets. This brings us to phase 2 of the drill down, park cracks. We are shifting over to the experiences division. Make no mistake, this is the steel frame of Disney, the physical theme parks, the resorts, the cruise ships, and the consumer products. While streaming is the shiny digital future, the experiences division has historically been the reliable, heavy-duty profit engine that actually funds the rest of the company's grand ambitions. And they delivered a record-breaking $9.49 billion in revenue for the second quarter. That's a 7% year-over-year increase. Operating income climbed 5% to $2.61 billion. And here is the real metric of structural strength. Per capita domestic guest spending was up 5%. Furthermore, they are executing a massive structural expansion of the Disney Cruise Line. They just launched the Disney Adventurous ship in March, based out of Singapore, extending their reach deep into the Asian market. The physical footprint is rapidly expanding. We are talking about hundreds of thousands of gross tons of steel and massive, multi-year capital investment to dominate Asian seas. Expanding, yes, absolutely. But the real question is, who is actually showing up? Because if you dig into the filing, domestic park attendance actually dropped 1% year over year. Management blames it on continued softness in international visitation, partly citing geopolitical tensions, tariffs, and just general macroeconomic uncertainty. But we really have to ask ourselves, is this actually severe consumer exhaustion? Just think about it. When was the last time you priced out a family trip to Orlando? Customers are facing sticky inflation, soaring energy prices, and they are literally maxing out their credit cards. A 1% drop might seem super small on paper, but when you are a business built on massive, unyielding fixed operational costs, a slight drop in daily volume can put immense structural pressure on your underlying supports. Is their legendary pricing power finally hitting a brick wall? Now we hit phase 3 of the drill down, bleeding cash. Okay, we've looked at the top line and we've debated the adjusted margins. But now it is time to inspect the absolute bedrock of any financial institution, the balance sheet and the cash flow. Because look, you can engineer earnings all day long, but you simply cannot fake cash. Here's your Bloomberg terminal-style breakdown. Entertainment is up 6% to $1.33 billion. Experiences is up 5% to $2.61 billion. Total segment operating income grew 4% to $4.6 billion. However, I will absolutely concede one major glaring weakness, the sports segment, heavily driven by ESPN. Operating income there dropped 5% to $652 million. This decline was heavily driven by higher programming expenses and massive rights fees. The reality is, big tech giants like Amazon and Apple are aggressively bidding up the cost of live sports rights, and ESPN is forced to pay a massive premium just to stay in the game. They actually expect sports operating income to decline approximately 14% in Q3 due to these escalating costs.
Exactly. And that ESPN drag, that is just the tip of the iceberg when we look at the overall capital drain.
This right here is the single most glaring crack in the foundation. Over the first 6 months of fiscal 2026, free cash flow didn't just dip, it was literally halved. It bled out from $5.63 billion down to a mere $2.66 billion. Cash provided by operations plummeted by over $2.3 billion. Why? Higher income tax payments and massive CapEx investments. For those who don't live their lives inside spreadsheets, CapEx means capital expenditures. It is the actual physical upfront cash investments, buying the heavy steel for new cruise ships, pouring the concrete for new park attractions. It's an incredibly capital-intensive strategy. When your free cash flow drops by 53% while you are simultaneously trying to convince the market you are a lean, margin-expanding machine, investors are going to hit the sell button hard. You are bleeding out cash just to keep the structure standing. Which leads us to Phase 4, regulatory traps. The threats aren't just internal, folks. We have to widen the lens to look at the macroeconomic and regulatory overhangs that are currently circling the stock. You can have the best blueprint in the world, but if the city inspectors shut down your construction site, you are dead in the water. First, the FCC has launched a review of Disney's ABC station licenses due to recent political controversies. Now, whether you lean left or right, we do not care. What we care about on this channel is regulatory risk. This creates real, unquantifiable uncertainty around some of Disney's most historically valuable broadcasting assets. Second, there is the massive ESPN strategy reversal. Wall Street desperately wanted Disney to spin off ESPN. Why? Because the spinoff would unlock standalone value and isolate ESPN's declining linear TV revenues from the rest of the healthy business. But Disney recently confirmed they are reversing course and keeping it inside the company. Reversing course signals that they are firmly anchored to this asset, taking on all those escalating programming costs we literally just talked about. Market Skeptic financial analysis platform Ticker.com summed it up perfectly. The FCC review and the ESPN reversal have removed near-term positive catalysts. That is the exact definition of deadweight. When you remove catalysts, you force investors to rely purely on long-term execution. There is no quick fix, there's no financial engineering trick left to boost the stock in the short term. And as an investor, you constantly have to think about opportunity cost. In an environment where you can still get a decent, risk-free return in treasuries, why would you let your hard-earned capital sit as deadweight in a stock, waiting years for catalysts to materialize while actively navigating regulatory minefields?
All right, let's look at the counter argument here, because management is aggressively buying back time and they're buying back trust.
It's time for the verdict, opportunity or trap. We've done the full drill down. We've rigorously inspected the revenue growth, the streaming margins, the massive cash flow bleed, and the regulatory headwinds. Now it is time to bring this combative analysis to a head and deliver the final iron financial ruling. Is Disney stock a generational opportunity to buy a fortress at a steep discount? Or is it a value trap ready to completely collapse? Here is the ultimate financial blueprint. On the bull side, you have the streaming margin inflection hitting 10.6%. That is a true structural paradigm shift. Management projects 12 to 16% adjusted EPS growth, and critically, they are targeting a massive $8 billion share buyback program. That buyback is a sign of absolute conviction. You don't just authorize $8 billion to repurchase shares unless your foundation is rock solid and you absolutely know your stock is severely undervalued.
And I am firing right back, because on the bear side, the reality is incredibly stark. Your GAAP EPS is down 30%. The home inspector found the mold. Your 6-month free cash flow has literally been halved due to those massive capital expenditures. You are facing an active, unpredictable FCC license review, and middle-class families are just straight up getting priced out of the domestic parks. That $8 billion buyback isn't conviction. It might just be artificial life support. They are throwing good money after bad to artificially prop up the share price while the cash continues to rapidly bleed out.
And that brings us to the final calculation. Disney is currently trading at roughly a 15 times forward earnings multiple. That is a significant, undeniable discount compared to its historical averages and many of its media peers. The valuation model targets a price of $124 over the next 2 years, which implies a potential 22% upside.
If, and let's be clear, that is a massive structural if,
They can execute perfectly, turn streaming into an absolute cash cow, and somehow dodge all of those regulatory and macroeconomic traps waiting for them. Exactly right. So we leave you with this final provocative thought to help you forge your own portfolio strategy. At a 15x multiple, is Wall Street fundamentally mispricing Disney's enduring structural advantages? Or are they accurately pricing in the heavy, heavy cost of repairing those financial cracks? You have the blueprint. The drill down is complete. Now it's your move.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.